Despite huge recovery expected in the third quarter of 2025, the Fed is actually cutting rates of 25 basis points. So there's a real divergence between what we are seeing currently in the economy and what the Fed is probably seeing, because the Fed is, of course, will not cut in economic growth, but is rather anticipating further slowdown in the overall macroeconomic situation. And this also gets confirmed in the housing market of the last week's release. So here in the middle, we are seeing a composite of the three major leading indicators in the single-family housing market index. And this level is at points where we previously also had recessions. So it's comparable with the 1990 recession. So we really see here a confirmation of what the Fed is also possibly seeing, but what is currently not shown in the economy yet. And the market is also somewhat lagging, in my opinion. We are currently up 52% from the low in April, which is a similar move to the upside in the 2020 bear market recovery. So really, to have it in perspective, this current recovery is just very extreme, and we should expect a pullback. Like this current trend is just not very healthy. And even though the overall trend might continue and get to more extremes overbought levels, I'm still expecting in the next 1 to 2 weeks in recovery, and you should really look into that. But coming firstly to the last week's key economic releases, starting with real retail sales, which were growing by 0.2% month over month. On a 6-month annualized growth rate, we were growing at 1.9%, which is still below the long-term average, but we can clearly see a very strong recovery. But in a long-term picture, we are still seeing stagnating real retail sales. But I like to look at the components which are more cyclical of the retail sales, which is furniture retail sales and motor vehicle sales, as the retail sales are mostly containing food sales, which are clearly not cyclical. And in that, we are actually seeing a further downtrend in the furniture sales, which of course highly linked to the housing market, which is also very bearish. Motor vehicles is still trending up very nicely, but as we can see in the past, it was also not really a good indication of recessions, other than the real retail sales in furniture. So really high ticket items, which people will not buy in an economic recession. We also got the industrial production, where I really like to look at the most cyclical part, which is clearly the durable goods production. And this index recovered to a growth rate of 3.2%, which is exactly the same as the long-term average growth rate. And this can be said that we might be at a situation where we saw a deviation from the average, then traded, run back to average. And the question now, of course, is can we hold that pretty strong current uptrend, or is this might indicate a further slowdown in the economy? What the Fed is currently clearly seeing, because the Fed would not cut rates if the economy is actually exploding, what we are actually currently seeing in the September Q3 in anticipation of growth rate, which is here in the graph. So the current GDP forecast from the Fed Atlanta is currently measuring growth rate of 3.34%, which consists out of 13 variables, which are released on a monthly basis, and really should be a very good indication of the real print of the third quarter of GDP. So this is a second consecutive quarter of above average growth. And the question, of course, and what also the Fed is seeing, that this growth is probably not can be held, and this might actually be a top. This week, we also get the building permits, which were falling, in my opinion, below a very key level. So in the past, this was always the start of a recession. So of course, it can be different this time, but it's just another confluence with the rate cut of the Fed. We also got housing starts, which also continues this trend, which is also very bearish signs. On month, this was actually a 7% decrease, which only happened 15% in the past 18 years. So this is a really very bearish month-over-month trend, and overall the trend is clearly showing high recession likelihoods. Similar signal in the NRP Housing Market Index, which assesses the current market for new single-family home sales along with builder expectations of future trends. and this is sitting at COVID lows, which just is confirming our overall sentiment of the housing market. And we also got the 25 basis rate cut, and this was actually, and we actually also got more slightly dovish expectations from the Fed. So initially, they only expected 2 rate cuts from the current 4.25% level, and now this year we actually expected to get 3 rate cuts. So despite the huge growth in the third quarter, this is really doesn't fit together. So the Fed is really seeing something, and it's also picturing itself in the housing market. Yeah, just to combine everything together. So building permits and also the 2-year yield is trending to the downside, which can be really comparable with past recessions. So the 2-year yield is near at levels of an collapse expectations, in my opinion. And here I also wanted to highlight this extreme move of a rate cut probability in the October meeting. So 1 month ago, that was at 43%, and now we're sitting at 90% likelihood. Yeah, just to summarize once more, so despite huge recovery in the third quarter of 2025, the Fed is cutting, and we're also seeing that in the housing market. Looking at the asset performances, the market is actually doing that what it did in the starting this year. So strong US market in dollar terms, of course. In euro terms, we actually flat. So you could also argue that the market is also not really extremely bullish, but still in dollar terms, we are making new all-time highs. And this week, asset performances was really, yeah, pretty bullish. And actually, the FMC event was not an sell the news event, how many people in markets was actually expecting it to be. So buy the rumor and sell the news, or sell the rate cut. This was not such a case. But I think it's just more interesting is the industry performances. So we are seeing home builders being down by 4% week to date. And this is actually also a trade I want to take. If I get a nice entry, I actually want to short home builders, because this is the first sign of weakness, and we are clearly seeing that. So despite the rate cuts, we should in some situation we should expect that especially home builders should get some relief, but the market is not really believing that. And I think this is really showing the positioning of the market, that it is a more recessionary situation we're in. But in general, we see the same picture as year to date. So tech defense doing very good, and actually healthcare stagnating. Yeah. The old trend is still very bullish. So I wouldn't really just short the market, because it can get more extreme if we look at past business cycles. So this is the past business cycles with the return in nominal returns of the S&P, and also the real returns, or adjusted for the CPI. And I also wanted to highlight gold, because many in the market, in general, the current trend is of course really, really extreme. But if we put it in perspective, it actually can go a lot of higher. So we still have, like the last row is the average. This is the current business cycle taken from the COVID lows. And if we look at that, gold is actually still way below the average growth in economic cycles. What is of course different than past economic cycles is that of course that actually the unemployment rate is actually like higher unemployment rates. And of course the unemployment is negative. So if it's not negative, but if the unemployment rate is going down, it's generally good, because there's less unemployment. But in this business cycle, we're actually seeing a different situation. But of course the question is, do you think that the COVID was a real business cycle, or was it just an anomaly? If you say, okay, no, let's put the business cycle from 2009 to 2025, because we didn't really have a normal recession, then we're actually up 914%, and then it would be very extreme. But if we take it from the COVID lows, there's still a lot of way to go. So if we get to extremes, and I think AI is absolutely a worth of a technology to make a big bubble. So I think we still can make a lot of more percentage. And as long as the trend is continuing its upward trend, I think we should also expect it, and don't take shorts. Yeah. But still, I think in the short term, the current upside is in a very extreme niveau. So I think on both ends, especially if we are on a long-term scale, I think there's still more upside. But on the short-term scale, I think there should be a pull down from here because we are up by 52% in the past, so to speak, cycles, short-term cycles. We usually got an pullback at around 30 to 40%. So this is pretty extreme in my opinion. But as long as the market is trending upward, and it currently is, so if we take in Fibonacci pool, we are actually always, like in this current upcycle, we are nearly always retracing to the 382 Fibonacci level and then recovering, which is a level which signals very aggressive uptrend and very strong bull market. So as long as we don't lose that level, shorting that is just not a good idea in my opinion. But yeah, that's more or less it. So I'm waiting for the bullback, but my current situation is that I'm not shorting the exact high. So I'm waiting for bullback. I'm waiting weakness in the market, and then I might take a short trade with a better risk reward. This week we actually got a huge and key data. So Tuesday we got S&P Globals already, which I'm going to cover next week, but they were slightly more bearish than expected, especially in Europe. US, they come in right as expected at 52 at manufacturing. Yeah, but we will cover that next week. We also get new home sales, which came in very bullishly, actually, 20% month-over-month move. So this might be an anomaly, in my opinion. It's just that problem with economic indicators. It's just in some months they just out of any reason because of that or that. Similar to the initial claims, for example, like 2 weeks ago, initial claims were extremely high, and this was only due to a fraud case. So of course you have problems in those month-over-month levels. So I would just really look at the trend and also at the market situation. And on Friday, I also got personal income and personal spending. So this was it for this week, for the previous week, sorry. So I'm really looking for a pullback, and but I'm not blindly shorting, but I'm looking for a market structure change. So yeah, that's it from my side. See you next week.